One morning in 2008, you woke up and everything had changed. Newspapers and TV screens were filled with images of chaos on Wall Street, but the real story wasn't in the headlines. The real story was about the ordinary people drinking coffee in their kitchens, sending their kids to school, heading out to the grocery store. Because this crisis didn't land on the banks, it landed on the backs of regular people. So how did we get here? Who or what caused this massive collapse? And more importantly, why didn't anyone stop it? Could it have been prevented, or was it intentionally dropped on us by those in power? Today I'm going to share with you a hidden story that Wall Street never wanted you to hear. The story of how everyday families became pawns in a game they never even knew they were playing. This isn't just about numbers on spreadsheets or confusing financial jargon. This is about real people who lost their homes, their jobs, their life savings, and most painfully, their trust in the system. And the worst part, the people who caused it didn't just walk away free. Many of them actually got richer from the whole thing. Maybe that was the plan all along. But before we dive into this rabbit hole and explore it in detail, I want you to do one thing. If you're ready to learn the real truth about what happened in 2008, hit that subscribe button and turn on notifications, because what I'm about to tell you will forever change the way you see banking, wealth, investing, and the entire financial system. It will open doors you didn't even know existed, and believe me, you'll want to share this with everyone you know, because the same patterns that led to 2008 are happening again today, just with fancier names and prettier packaging. This might be the wake-up call your family and the people around you never knew they needed. Now let's go down the rabbit hole. In the early 2000s, there was a beautiful lie sold to nearly every American, the idea that owning a home was the guaranteed path to wealth. And based on that belief, housing prices would never fall. So banks started throwing money at anyone with a pulse, giving mortgages to people who couldn't afford them, people without jobs, without documents, and even people clearly headed for default. But here's the trick. Banks didn't care whether those loans were ever repaid. Why? Because they weren't holding onto those loans. They were packaging them up and selling them to someone else like a hot potato. This strategy worked in their favor, but it was going to crush regular people. Now here's where things get really crazy. Those mortgages weren't just sold to one buyer, they were broken apart, mixed together, and repackaged into something called mortgage-backed securities. Think of it like putting up a product online, selling it to 5 different people, then disappearing. Imagine tossing 1,000 different loans into a blender, some good, some absolutely terrible, and then selling pieces of that toxic smoothie to investors all over the world. You probably get the idea. It's a nightmare. These investors had no clue what they were really buying, but they were told it was safe because the products had received magical AAA ratings from credit rating agencies. But ask yourself this, why would anyone trust a letter on paper? So who were these credit rating agencies? They were supposed to be the referees of the financial world, the ones who tell us what's safe and what's risky. But instead, they were being paid by the very banks whose products they were rating. Imagine a food critic getting paid by the restaurant they're reviewing. What do you think will happen? Drop your thoughts in the comments, because we're going even deeper. Now let me tell you how this financial weapon finally exploded. Remember, banks had packaged up those toxic loans and sold them all over the world, but no one really knew what was inside those packages. Even the smartest guys on Wall Street couldn't fully understand what these complex instruments really meant. Mortgage-backed securities, collateralized debt obligations, synthetic CDOs. They sound like professional tools, right? But in reality, they were just fancy words to make garbage look like gold, like fake gold jewelry trying to shine in the dark. All for show. And right here, the most infuriating character in our story enters the stage. Hedge funds. These guys didn't just take risky bets, they actually saw the collapse coming and placed their chips accordingly. They bought something called credit default swaps, financial instruments that were basically insurance policies on the crash of the mortgage market. Imagine knowing your house will burn down, buying fire insurance, and then setting it on fire yourself. That's pretty much what these people did. But the real tragedy is that the bill for this game was handed to regular people. Why should poor and innocent families pay the price for someone else's mess? In 2007, when housing prices started to fall, people who couldn't afford those beautiful mortgages began to lose their homes. And every time a family lost their home, the mortgage they had was one of thousands inside those giant packages. And when one piece rotted, the whole thing started to fall apart like dominoes. This wasn't just about money anymore. It was about people breaking down, even dying, because they lost everything they had worked for. Giants like Goldman Sachs, Lehman Brothers, and Bear Stearns lost billions overnight. And these weren't just numbers on a screen. This was your retirement fund, your college savings, your city's budget, even foreign central banks' reserves. Because those toxic investments weren't only sold in America, they were shipped all over the world, diced up and delivered everywhere. And here's the most ironic part. Many of the people who caused the crash didn't just lose their jobs. They kept collecting massive bonuses. Executives at AIG got million-dollar payouts while the company was going down. Top people at Fannie Mae and Freddie Mac walked away with pockets full of cash, even as the government was rescuing their institutions. What kind of justice is that? Where the guilty get rich and the innocent get crushed? And now comes the biggest lie of all. They told you the banks were too big to fail. The government had no choice but to save them, or the entire economy would collapse. The banks were supposedly the foundation of everything. But here's the question: who paid for those bailouts? Sadly, it was us, the taxpayers, the regular people, the ones who didn't cause any of this. So to sum it up, the banks took the risks, made the profits, lost the game, and got rescued with our money. They wrecked the system, and we were the ones who saved them from the mess they created. I bet you're thinking this is completely insane. And right about now, you're probably asking yourself, if it was this obvious, why didn't anyone stop it? The answer is simple but disturbing, because people at every level of the system were getting a piece of the rot. Politicians were funded by lobbyists, regulators were working hand in hand with the banks in a revolving door of influence, and the media didn't speak up because they didn't want to lose their ad money. If they had told the truth, they'd be shut down by morning and erased forever. But this story doesn't end in 2008. They made it seem like the crisis was over, but the truth is the same toxic structure still exists today. Only the names and faces have changed. The formula is still the same, just the variables have different labels. Big banks got even bigger, the risks got even riskier, and now the stage is being set for the next crisis. That's why knowing this story matters so much. History repeats itself, and the next time it hits, you need to be ready. The past is not just a memory, it's a warning, and this is far from over. We're going even deeper in the next part, but first, make sure to like the video and drop your thoughts in the comments. Now, I'm going to tell you the darkest part of the story. Right after the 2008 collapse, the government launched a massive rescue operation, but you're about to see who they really saved, because the story you were told and what actually happened couldn't be more different. Let's break it down. On September 15th, 2008, when Lehman Brothers went under, Wall Street went into full-blown panic. But here's the strange part. That panic only lasted a few days, because right after that, the Federal Reserve and the US government launched the largest bailout operation in history. They handed $85 billion to AIG, $45 billion to Bank of America, another $45 billion to Citigroup, and in total, a $700 billion program called TARP was announced. But that was just the beginning. The Federal Reserve started printing trillions under a policy called quantitative easing. Between 2008 and 2014, they printed $4 trillion. Now you'd think that money would go to help the economy recover, but in reality it went straight to the balance sheets of big banks. The banks didn't have to pay for their bad bets. Instead, they were saved with your tax dollars, and for them, this was like coming back from the dead. And while I'm saying this, I can't help but feel uneasy just thinking that those billions were used to rescue the very people who caused the mess, and tonight I might just lie in bed thinking about that. But let's keep going. The most disgusting part is that even during the rescue, bank executives kept collecting million-dollar bonuses. The same AIG leaders who helped tank the company walked away with huge checks in the middle of the crisis. JP Morgan CEO Jamie Dimon made $20 million. Goldman Sachs executives kept pocketing bonuses while taking government money. Imagine a store going bankrupt and still giving bonuses to its staff. Sounds crazy, right? That's exactly what happened. So what happened to regular people between 2008 and 2012? 4 million Americans lost their homes, unemployment shot up to 10%, retirement funds lost a quarter of their value, college savings vanished like smoke, and the banks, they were back in profit by 2010 and paid out record bonuses in 2011. That's the twisted part. They never really lose, they always win, because they never actually risk anything themselves. This is the truth you were never told. This wasn't socialism, it was something worse. This was a system where the losses were dumped on the public, while the profits were kept by the private elite. In English, we call that privatizing profits and socializing losses. They win, you lose. But here's the most dangerous part. The system never actually changed. Even now, in 2024, the big banks are bigger than they were in 2008. JP Morgan Chase had $2.3 trillion in assets back then. Now they have $3.7 trillion. Bank of America grew just the same, so the too big to fail problem never got fixed, it actually got worse. Even the laws meant to prevent another crisis, like the Dodd-Frank Act, were slowly watered down during the Trump administration. Many of the key rules were rolled back, and now the same risk-taking culture is alive again. Private equity funds, hedge funds, high-frequency trading, all of it is happening again, just on a larger scale than ever before. So what can you do to protect yourself? First, minimize your debt. Second, build an emergency fund. Third, diversify your investments. And never put money into anything you don't understand. Fourth, grow your financial knowledge every single day. And above all, never forget that the system is not built for you. This story isn't just a lesson from the past, it's a warning about what's coming. The countdown to the next crisis has already started because the root problems were never solved, just delayed. So stay alert, get prepared, and most importantly, don't trust the system blindly. And now here we are in 2025, 17 years have passed, but the truth is, nothing has really changed. In fact, things have gotten worse. Today, the mortgage market is bigger than it was before the collapse. Consumer debt is at record highs. Credit card debt has passed $1.2 trillion. Student loans are at 1.8 trillion, and home prices they're more than 60% higher than their peak in 2008. But wages haven't grown at the same pace, which means ordinary people are struggling even more than before. Meanwhile, big banks are more powerful than ever. Thanks to years of ultra-low interest rates from the Federal Reserve, they borrowed money for basically nothing and invested it in high-return assets, making trillions in profit. The stock market has been artificially pumped up, real estate is back in bubble territory, and new financial tools have appeared like decentralized finance platforms, artificial intelligence, investment funds, and carbon credit derivatives. So what about the regulators? The same revolving door between Wall Street and Washington is still spinning. Former Fed officials land million-dollar jobs in the private sector. The banking lobby is stronger than ever in Washington, and the media, it's even more dependent on advertising from financial companies, which means less honesty and more silence when things start to go wrong. And here's the scariest part of all, the next crisis will be even bigger than 2008. The system is more fragile, the debts are larger, and the government's ability to rescue the economy is more limited. Now that the Fed has started raising interest rates, this fake balloon is getting ready to burst, but this time, you can be ready. Start by building an emergency fund. Pay down your debts, improve your financial literacy, and most importantly, stop trusting the system blindly. Because when the next crisis comes, the banks and the government won't be there to save you. This story isn't just about the past, it's a warning about the future. If we don't change the system will change us, and this time it will be much more brutal. Stay awake, stay prepared, and never forget what really happened.